In Investing 101, how the Fed moves are affecting the stock market and the housing market. Here to explain is John Bever, the president of Phase 3 Advisory Services, a registered investment advisory firm and registered principal with Royal Alliance Associates. Good to have you here, John. And what do you think is next for the Fed?
Well, set up here, the Fed is fighting inflation, and they've actually partly created this with $9 trillion on their balance sheet. That's a lot of money that's in the system. So the Fed is now prepping the market for these rising rates. They're indicating maybe even 0.5% at their next meeting, the FOMC meeting in May. You know, if they increase rates at 0.25% every month this year, that could be 8 more rate increases. That could put the short-term rates at about 2.5%. So why would they do that? Because they're trying to really fight this inflation, but they may be behind the curve.
What's the immediate effect on the housing market as rates rise?
One thing to watch with this are mortgage rates. They've been increasing at about 0.25% each month, 0.25% January, 0.25% February, maybe 0.25% in March. But what's interesting is housing prices are still rising. Usually when the rates go up, the housing prices will level off, maybe even decline. That could still be a few months out. Home sales have been revised lower for the rest of the year, but we're sitting with a situation where we have so much supply shortage at this point in time that there might be pricing pressure by the builders and by the consumer that's still willing to borrow because they have a lot of ability to borrow at this point in time.
Moving on to the stock market, what do you see happening there, John?
So when rates rise, it tends to be hard for the stock market. Now, earnings do look good even through the rest of the year. But when the interest rates rise, it creates this valuation compression. You see, the stock market investors are demanding more return as interest rates go up. That means the stock prices have to be a little bit lower where they're starting from. So if the market rallies here, it might be a bear market rally. You see, the market is not yet priced for a 3% plus yield on the 10-year Treasury rate. If we go above that, the stock market could really run into trouble. So we may be seeing a sideways market until those rates reach 3%.
Is this a good time to keep some cash on hand?
So it's okay to have some cash on the sidelines as interest rates are rising. That helps you with future dips to have some money to go buying with. You also want to make sure that you have cash that you're going to need to spend in the next couple of years. Now, I like the 2-year maturity point on the yield curve. In other words, don't go long-dated bonds, don't go buying long-term bonds at this point in time. For your stocks, I would continue to sell growth stocks and actually buy value stocks. It's also not too late to buy natural resource companies. If this is going to be a long-term inflationary cycle, this may still be a very great opportunity to buy buying natural resource companies and funds. I would also consider real estate investment trusts as an alternative to your longer dated bonds. Stay away from the longer dated bonds. Pick up the REITs that have some inflation protection with them, but I would concentrate on those companies that have lower debt levels. And aggressive money could actually start buying the emerging markets, believe it or not, but I would stage in that money over about the next 2 years.
Well, thank you, John, as always, for helping us out with Investing 101.
Thank you for having me.
Go to businessfirstam.com for where to see our show on TV.